Good morning, guys. So today marked the first day of trading for the year, and I just wanted to share a quick video with you on how to identify potential market reversals, particularly after a significant sell-off like the one that we experienced during the market today. And so let's dive right into it. Today I primarily traded ES and UB throughout the day. So for this illustration, I'll focus on ES, the SP500 mini. And so this is a 15-minute chart I have on my screen. And at the bottom, you see a couple of boxes. You see a green box here. You see a blue box here. And you see the candlesticks come down to that price through the day. And initially, when I first touched this green box, we had a couple of bounces. Came back up to the moving averages. Got rejected at the moving averages midday and came down again. And the second time around, it flushed down to this turquoise box. And at the end of the day, we had this big pop back to the EMAs. So as you can see, these two highlighted boxes were kind of a key pivotal range or key pivotal level where price responded and buyers came in quickly. So now if we zoom in a bit, you'll notice these levels that I've marked here in green and turquoise, they do correspond with specific values. So I'm going to draw a fib expansion level based on the prior day's trading range from the high to the low. So to help us here, we have the London session highlighted in blue here. We have the New York session highlighted in orange here. And together they encompass the full prior day range because the high was in the London session, the low was in the New York session. So first off, I'm going to do the full day fib here, expansion. I'm just drawing with the fib tool, the high to the low. I'm just going to leave it over here. And I'm going to do the same thing for the New York session, which is the regular trading session, the RTH, from the high to the low. So when you extend these Fibonacci levels to the 1618, you can see the RTH 1618 lines up at the bottom of this box. And the turquoise box here lines up with the 1618 on the top side with the full day range. And so you might wonder, why is it on the top and the bottom? What I've done here now is to combine it with some other information. We have in purple here, or these magenta lines, some FVGs or imbalances from a few days back. You can see there's a large bullish candle here and another one here. And if you zoom in on the 5-minute or even the 1 minute at those time frames, what you'll see is a very clear fair value gap or imbalance in between buyers and sellers. So there was one right here that was unfilled, another one right here, and yet another one down here. That's another exercise we can do to identify those FVGs. But effectively, what I'm looking for are those pools of liquidity that are nearby so that I can form a range where price may consolidate and then reverse. So you can see this magenta line forms the top of this turquoise box, and here at the bottom at the 1618 for the full RTH range, forming the bottom of the box. And for about 4 hours to the morning, price tested that level. Essentially, the liquidity that was remaining from that day got hit up here, and then price, once it exhausted that pool, moved away from that box. So this is a powerful way to anticipate the market reversals and plan your trades accordingly. So what you can do is either wait for price to come all the way down for exhaustion and trade for these bounces, or if you're shorting from an earlier entry, you can continue to hold that short until price has reached one of these boxes, and then you can close, and then once again short until it reaches one of these boxes. So keep an eye on those Fibonacci levels, especially during a strong sell-off, because the reversals will be swift and quick. This 1272, there wasn't a huge liquidity FVG pool there, an FVG there, but there was still some market response. So it was a bit of a algorithmic buying at that little technical level, but price continued to come down again. So you want to monitor the reaction at those price levels. So just to summarize here, simply just draw the fib expansion for the prior day RTH and also draw the fib expansion for the full prior day. And basically that's the 24-hour block from midnight to midnight I have here in the dashed lines. So it's a very simple technique. The key level will either be the 1272 or the 1618 fib. Of course, it can be other values such as a 2.0, 2.72, 2.618. And basically what you're looking for is how much volume there will be for that day. The price will expand a certain degree more. If there's a lot more volume, it will mean more liquidity. And so that will depend on a few factors. You want to take a look at how much volume there will be for that trading day. Look at whether or not there are any key events that might bring in a lot of macroeconomic adjustments. Take a look at the free liquidity pools around the price range from the prior day. A lot of times price will come and take up that liquidity nearby. So that's a quite important factor. Then you can also look at the market participant reaction as it reaches those values and see whether or not you see the buying come in at that expected price level. So rarely do we see it go down to 2.72, 2.618. Those are really on very unusual days, like when CPI news comes out. So hopefully that's helpful for you. If you have any questions, feel free to drop a comment below or ask questions in our Discord. Happy trading, and hopefully you have a successful year ahead.